Alright guys, welcome back to the channel. So the stock market so far in 2022 has been pretty crazy. And of course, the majority of this is being perpetrated by two primary factors: the conflict overseas in Ukraine, and here at home, the issue around inflation and interest rates. I mean, just today the market was down about 1%, and then midday, there was a huge turnaround, and now it's up about 1%. So there's just a huge amount of volatility and uncertainty in the market. But zooming out a little bit, historically, what this usually tells us is that right now is potentially a great buying opportunity. It's relatively equivalent to being able to go back in time to late 2018 and buying the dip. Of course, the situation today is different. There's a lot more uncertainty, but the opportunity might still be there. So the point of today's video is to take a look at some great dividend-paying stocks that you might be able to get at a solid discount. But really quick, before diving into this, if you guys enjoy the video, you guys know what to do. Leave a like, subscribe. I really do greatly appreciate it, and it helps out the channel a lot. But let's dive right into this. So I have a list here of a bunch of really high quality companies that I was doing some research on. For the most part, these are all very high quality companies, but I do have a few crossed off like Kimberly-Clark because they have a growing amount of debt and the revenues are very flat. So I just don't think they have a lot of growth in the future, even though it's a quality company. I also have names like Citigroup crossed off because they have a flat dividend and they're not growing it at all. And Clorox, extremely recognizable company, we all use their products, but they have falling net income. But to back up a little bit, whenever I begin to do stock picking and research into companies, I begin by picking stocks from three main sources. First is I do some screen picking on quality dividend ETFs like SCHD, so it only makes sense to copy their homework a little bit, or at least confer with them when you're trying to find good dividend-paying companies. Another resource we have here are stock screening websites. So this is FinViz, and this tool here allows you to screen stocks based off of all of these fundamentals. So for example, if you only want mid-cap and over, you can select that here in the settings, as well as things like the PE ratio. So here I have under 20 and dividend yield over 3%. And once you do that, the website spits out all the stocks that fit that criteria. And then to me, the third choice you have here is a ratings website. So instead of screening by the fundamentals, you can screen by things like investor sentiment, price target upside, and many other factors. So for example, you can filter by companies that have very bullish news sentiment, and then it spits out the results down here. And using the combination of these three tools, that's how I came across these names right here. And then once I had these names from these sources down here, I began to do my own research into their fundamentals, and I began to cross off names that I didn't prefer. So for example, the Kraft Heinz company, ticker KHC, is a very recognizable blue chip company. But if we look at some of the fundamentals of this company, like their total revenues, as well as their net income, we can see an extreme lack of growth. And that just tells me that even though they're a name brand, that they're pretty saturated in their market, and they're not doing much to innovate, and as a symptom of that, they're actually cutting their dividend. Another important point is that none of these names exist in a vacuum. You always have to factor in the opportunity cost, because if you put 10,000 bucks into Kraft Heinz, that's 10,000 bucks you're not putting into Kellogg's. And if we do the same analysis for Kellogg's, we can see that both their revenues and their net income are growing. Don't get me wrong, it's not by a lot, this is not a growth company, but we can see that it's just in a better financial situation, and their payout ratio is actually falling as a result. So in this sector of consumer defensive products, I would choose Kellogg's over something like Kraft Heinz, even though they're both great companies. Now, another area that I see a lot of value right now is with the semiconductor plays, namely Broadcom and Texas Instruments. If we come over here, we can see that both Broadcom and Texas Instruments have had a bit of a sell-off recently, making them a bit cheaper. And as a result of that, Texas Instruments has a PE ratio of 17.8, and in terms of their revenue and their net income, they're both growing at a pretty healthy pace. That helps to support a dividend yield of almost 2.8% with a very fast growth rate and a healthy payout ratio. And finally, as another data point, the overall sentiment here is pretty bullish on the company. There's a 6 out of 10 rating with a moderate buy consensus. Even taking a look at some of the more recent articles on Seeking Alpha, just to get a broad data point on the sentiment out there, it's pretty bullish for this company. And if we come over to Broadcom, the story here is much the same. In fact, I would say with this company, the fundamentals are even stronger. The dividend is very similar, and here the independent website gives them a 10 out of 10. So I definitely see a lot of value in these two names right now. Another spot I see a lot of value currently is with the financials. And just in general, when there's rising interest rates, people tend to flock to financials and banks because they benefit from that. And with the exception of Citibank, TROW, BlackRock, Morgan Stanley, and JP Morgan Chase, to me are all extremely high quality picks. TROW is the smallest company of the bunch, and they had a pretty massive sell-off recently, down 20% for the year. But this company has squeaky clean fundamentals. The revenue growth is extremely impressive, their net income follows it very closely, their payout ratio is falling, and that's as they increase their dividend by double digits each year. And because this company just sold off 20%, their dividend yield is spiking. And BlackRock, Morgan Stanley, and JP Morgan are all in pretty similar situations. Of course, they all focus on slightly different parts of the market, but I think they're all extremely high quality companies that are poised to do extremely well. Now, aside from that, we do have a couple other no-brainers to me, beginning with Lockheed Martin. So with all of the conflict currently going on in the world, a defense company like Lockheed Martin is directly going to benefit from this. And that's why this is one of the few companies that this year is up sharply. Now, even with this turn upwards, I still think this company is a great value with a PE of 17.3. Now, being that they're a defense contractor with the Department of Defense being their biggest customer, their revenue is extremely predictable and reliable. And even before the current events going on right now, in my opinion, Lockheed Martin was a very high quality company. They have a solid dividend, a low payout ratio, and a fast dividend growth rate. Now, two other companies benefiting from the current situation are oil companies including Chevron and Exxon Mobil. In terms of which one is better right now, you can see I put a note here that says pick your poison. These companies just take black gold out of the ground and sell it on the market and make a ton of money. Now, of course, long term in the future, hopefully we're going to move to a clean energy society, but as we're being reminded right now, these companies are still very important for the global economy. Okay, and then finally we have some healthcare companies, and to me, these are four of the absolute best in the market. We have Amgen, AbbVie, Merck & Co., and Pfizer. Now, I do want to say that I'm not an expert on healthcare. I'm not familiar with the entire landscape, but from my research as well as screen peeking on high-quality ETFs like SCHD, I believe Merck & Co. is one of the best right now. The stock really hasn't moved too much recently, and the P/E ratio is only 10. And we can see here that the independent rating website gives this company a 10 out of 10. Their EPS growth is great for such a huge blue chip, well-established company, and from what I gathered, this company is doing a lot of research and development to make sure that this growth proceeds into the future. And of course, as an investor, that's exactly what you want in your companies. So there you have it, guys. In my opinion, these are some of the best dividend-paying stocks in the market, but I gave you my whole thought process on why I like some names better than others, as well as my general research process for picking individual stocks. I hope you guys enjoyed the video. If you did and you're still watching, I appreciate a like on the video, subscribe to the channel, all the kind of YouTube stuff, and I'll see you guys in the next one.